Hello everybody, welcome into the NinjaTrader ecosystem webinar room. Before we get started with today's session, I'd like to take a moment to test for picture and sound. So if you can hear my voice, and if you can see the MTPredictor slide on screen, can you type the letter Y into the room, just to confirm that you can hear my voice, and you can see the image. Alright, looks like I'm getting lots of confirmations. Thank you all for confirming that, and thank you all for joining the webinar today. My name is Ryan Lai. I work at the Denver office for the NinjaTrader business development team. And we have a very special event for you today with Steve Griffiths of MTPredictor. Before we get started, I did want to get a gauge of the type of user in today's attendance. So I have a quick little poll, and the question is, are you currently using NinjaTrader? While you fill out the poll here, it does give me a chance to show you a disclosure in the room and also read over it. I'd like to mention to everybody in the room that it is important to understand that there are substantial risks in trading commodity futures contracts, and you should carefully consider whether such trading is going to be suitable for you, and this will depend on your specific circumstances and financial resources. It is possible to lose all of the funds that you deposit with your broker, and you can even incur losses beyond these amounts. You can always inquire to the risk disclosure that I posted into the room for more information, and you can get the full copy of the CFTC full risk disclosure there. Also, please remember that these training webinars are not a solicitation nor a recommendation for any services, but simply educational in nature. And this presentation is being presented by NinjaTrader LLC, which is the technology company responsible for developing and supporting the NinjaTrader trading software. If you have any sort of NinjaTrader brokerage questions, they should be directed to the NinjaTrader brokerage directly. You can email brokerage@ninjatrader.com, or you can call directly at 312-262-1289. All right, thanks everybody for filling out the poll. Looks like most people had a chance. And in the lead, we have lifetime license key members. So it's great to see people that have committed to the platform, also interested in our third-party services. For those of you who are not yet using NinjaTrader, we're going to give you a download link here. You can download NinjaTrader for free and get started. And you can follow along with any of our product training or ecosystem webinars. For anybody who's curious about purchasing or leasing the platform, I'm providing a link to the purchase page, and you can take a look at all of our purchase and lease options. All right, so with that being said, we are very excited for this unique event today, in which Steve Griffiths will show you how to use his unique isolation approach to Elliott Wave to avoid confusion that's normally associated with Elliott Wave Analysis. In this event, Steve will demonstrate how the MTPredictor add-ons for NinjaTrader 8 uncover potential trade setups while managing risk. So thank you again for your attendance today, and without further ado, it is my pleasure to welcome into the NinjaTrader webinar room, Steve Griffiths. Go ahead and take it away, Steve.
Right, thank you very much to Ryan and NinjaTrader. Just while I just start the screen sharing, just bear with me for a second as I start that. Right, if everyone could just let me know whether they can hear me okay and whether they can see a NinjaTrader chart there. While I again just say thank you very much to NinjaTrader for bringing me in to do this webinar today. It's good to be working again with you guys. We first started working with NinjaTrader back in 2005, I think it was. So that's 12 years now. So been with you, working with you guys for a very long time. So yeah, just want to remind everyone again, I know Ryan's done the risk disclaimer, but just remind you losses can and will and do unfold. You have to be careful, keep stops there and keep losses small, but losses can and will and do unfold. It's a fact of trading life. And also remind you that all examples we look at today are just for illustration and training purposes only. Right, so let's get started. So the title is Getting Elliott Wave Under Control. What do I mean by that? Well, for you guys who are familiar with Elliott Wave, you'll know that it was basically developed a long time by a guy called Elliott, and the idea being is that markets make certain patterns, and from that, if you know where you are on the patterns, you know where the market's going to go. For you guys who know nothing about Elliott Wave, don't worry about it. I'm not going to go into great depth here and put everyone to sleep. Basically, what I want to show is my journey over the last 30 years. I started looking at the markets back in 1987. MTPredictor as a company started in 2001. So that's what, 30 years experience, and MTPredictor has been going for 16 years. So we've been around the block quite a few times. So how did this all start? Well, back early in my career, back in the early 90s, after going through some hard times to start with, listening to brokers and things, nothing against NinjaTrader broker, you weren't around then, but realised that I wanted to try and look at a way of analysing the markets, and I was drawn to Elliott Wave and geometry. I like the idea of Elliott Wave, and like the idea of having patterns on the charts. Basically, markets go in impulsive swings in 5 waves, and then do corrective swings in ABCs. That's the basic of Elliott Wave. But then what happened is that as people started to look at the markets in more detail, they wanted to try and fit everything together, because the idea being is if you know where you are in the pattern, you know where the pattern's going. But what I realized, as many people do, is I've just shown a 5-wave sequence and an ABC sequence there. But if I go back on this chart, by the way, this is a 15-minute chart of the YM, you suddenly get back a bit further and say, well, what was the pattern here? What was the pattern here? Well, I don't know. What was the pattern back here? Well, it starts to get a bit confusing. So what Elliott Wave analysts did was then they developed alternate counts, developed X waves and various other waves of basically trying to fit in the pattern all of the time. Now this I struggled with, and I don't know whether you guys who do Elliott Wave or had a look at Elliott Wave yourselves will resonate with this, but all too many times you'll get a lovely pattern, then suddenly it would fall down and the analysis wouldn't go right, and it would all end up in tears when basically the market would go in the wrong direction. So I looked at this and thought, well, hang on a second, surely there's a way to get around this. So as I looked at markets more and more, I realized that there are times when the market is basically random. In other words, it's going through times when there's no clear pattern. But within that, there's times like we see here on the YM going down to this last low. There are times when you get a nice, lovely 1, 2, 3, 4, 5. Then you get lovely times when there's a nice ABC pattern as well. So there were times when the picture was clear, but there were also times when the picture wasn't, when it was random. So what I started to realize was that markets go through cycles. In other words, they have times when they're random, they have times when the picture's clear. It's like driving through fog. You get times when you can't see the road, and basically you don't know where you're going. You have to slow down or stop or go nowhere. Then the fog clears, and suddenly the road becomes a bit more obvious, and you can start to drive a bit quicker and you know where you're going. So this is what I basically started to develop, and took the idea that markets were going in cycles, which I nicknamed the cyclical nature of trading, cyclical nature of markets, and then looked at say, okay, how do you then approach an Elliott Wave strategy that's meant to predict things 100% of the time in basically an environment that's random half the time? Well, I said, how about looking at things in isolation? In other words, let's only work with the good picture when the picture's clear. Now, to me, that made perfect sense. But that went against a lot of traditional Elliott Wave teaching, because effectively I was saying half the time the market's random, therefore you shouldn't look at the market at all. But I went on and developed this over the years, and this became the backbone of MTPredictor. So how do we do this then? Well, how do we know when the picture's becoming clearer? In other words, how do we know where to start? Well, the way we developed was basically we looked at the higher time frame chart. So this is a 15-minute chart. A higher time frame, we look to a time frame that's between 3 and 5 time frames higher, the next logical time frame up. So if you're looking at a 15-minute chart, you'd go out to the 60-minute. If you're, say, looking at a daily chart, you go out to the weekly. If you're, say, looking at Forex charts on, say, a 4-hour or 8-hour, you'd probably go out to the daily chart. So you're looking for something, a logical time frame above that you're trading off. And for this, we then wanted to see where the markets are going to come into support and resistance zones. I'll just put a bit of space on the right-hand side here. I'll move the chart just over a little bit here. So what we're looking at is we're looking at areas where we could anticipate support and resistance, and for this we develop what we call our decision point. A decision point is an area where, quite simply, we hover over a pivot like I'm doing here. I right mouse click and then select decision point. This gives us an area on the chart in advance, but that's the important point. It's a leading indicator. It's there on the chart in advance. In other words, it's out there ready for the market to go to it. We're not saying it's going to, but what we're doing is we're waiting to see if the market does react at these levels. So on this 60-minute chart of the YM, there was the support level. The market then came down, hit that level very nicely, and then started to rally back up again. Let's just go to the 15-minute chart and see what that looked like on the 15-minute chart. Here it is on the 15-minute chart. So here you were looking to trade the 15-minute chart, and you had this area of higher time frame support there on your chart. The market comes down and suddenly hits it. In other words, the picture starts to suddenly become clear. The market starts to react off this. In other words, it's doing what you're anticipating it's going to do. In other words, you're anticipating support, it's found support. So how do we trade this? Well, there's a trade setup right at the bottom there. You can see there's a little triangle, which we'll come back to as a second trade setup I want to talk about that we do in MTPredictor. But the first one I want to look at is one of my favorite trade setups. It's where the market goes up. The initial move off the start of a sequence in Elliott Wave terms will be a wave 1. So wave 1 is the first move off an important low in this case. What we're looking for next is for a wave 2 to unfold, and I'll show you why in a second. But from Elliott Wave principles, we know that a wave 2 tends to subdivide into a minor ABC. If I scroll forward, I'll come back to that TS1 setup in a minute. But what we're looking for is we're looking for an ABC correction. If I right mouse click and do our Elliott Wave Intermediate, this is what it's found, an A and a B and a C. Why do I like this one so much? Well, because in Elliott Wave terms, if this is a wave 2, then after a wave 2, we're anticipating, we're not projecting it's going to happen because we know markets go in cycles, but we're projecting a potential wave 3. Why do we like that the best? Well, if I clear this off and I place the analysis on this setup, so for this I'll just right mouse click over our blue buy bar, do analysis. Why do we like this? Well, because a wave 3 is typically the strongest and longest wave in a completed 5-wave sequence. So what I basically did all those years ago was, rather than throwing Elliott Wave out and saying, well, half the time it doesn't work, I don't like it, it's something that's unworkable, what I just basically decided to do was to say, right, what happens if we just look in isolation at when a market starts to make support or resistance at a logical level, in this case off a higher time frame support, and we say, right, okay, let's just now say that the market's starting to become clear here. So we start our sequence there. We're then looking for this particular pattern. We now know that if the market is now going to go up to here, this could be a strong move. This suddenly becomes a good tradable opportunity. In Elliott Wave terms, this is a wave 2 up to a wave 3. W.G. Gann also liked this as well. He cited this as the best place to buy stocks on the first correction in a new swing. So this is what we're looking at, the first correction in a new swing. If I scroll forward, zoom out a bit, if I scroll forward to what the market's done today, you can see that's exactly what the market did. It made a nice strong move, went beyond our typical wave 3 WPT here and actually went a bit beyond it. But the point being is that you captured a strong move. So this was the basic, or the first setup that I was looking at to say, well, hang on a second, to me this looks like a potential good trade with a small risk for a good profit. So why don't we look to try and trade this in isolation? This is why we've nicknamed it one of our trade setups. I'll come back and look at this TS1 buy setup here in a bit, because I want to look at losing trades in respect to our position sizing a bit later on, and show you how it's not dollars that's important, it's the profit size in relation to the losses, because right at the start we said losses can and will and do unfold. They always will do. The trick is trying to keep the losses small. But this was basically the whole idea of my ethos of trying to get Elliott Wave under control, was realizing that markets going through cycles where basically the markets are random. So even though we have trade setups here, I'm not suggesting that you actually trade MTPredictor like a black box system. What I'm suggesting is you trade it when the pattern becomes clear and you get some a good clean pattern coming into higher time frame support. Is there any other rationale for this? Well, there is, because if you look at fund managers, what they tend to do is they look at their systems, and on their systems they'll tend to follow their trade setups 100% of the time, but they'll put a moving average on their results, and then they tend to only actually trade, in other words place money on their trades when their system is above their moving average. In other words, when their system is in a good cycle. So in other words, even though fund managers effectively trade black boxes, i.e. system trading, rather than what most amateur traders do, trade all the time, and they have setups when the market is in a bad cycle losing, what they tend to do is only trade when their system is in a good cycle. So that's again another way of looking at the cyclical nature of trading. In other words, markets go in cycles, profits and losses go in cycles. There's a video on our website that I won't show you now, but you can go and have a look at later that shows a bit more detail on that. So the question I hear you all asking is, this is all well and good. This was a trade setup that unfolded literally over the last day or so on this 15-minute chart of the YM. Actually, there's a slightly better one on the ES. If I go to the ES, there's the ES. There was a Holy Grail buy setup on the ES. If I put the analysis on that, that was actually a slightly better trade, going to its typical wave 3 target for a slightly bigger profit. So that was actually a bit of a nicer trade. And yes, if I go out to the 60-minute chart to place the support on, there's the last pivot low. This is where we do our DP levels on. So wouldn't it have been nice to know, literally, as the market was declining down here, remember, we're not looking to buy and sell all of these setups. We're only looking to do them when the picture becomes clear and when things make sense. So what we're looking for is, as the market was coming down here, having this support zone on your chart, literally days. I mean, here's back on the 9th of November, that low was. So since then, that level would have been on the chart, waiting for the market to get to it. If I now go back down to the 15-minute chart, you can see there is how it came in at the low. So I can hear you all asking, that's all well and good, but is this just a one-off example, just came in here yesterday? Well, I want to apologize for this next chart, because this is actually taken a screenshot in our standalone version, and we're actually doing a presentation for NinjaTrader, but the data I had for this was only available in our standalone version, and actually I didn't take a screenshot of this. It was quite a few years ago I looked at this, but I just want to show it now. Is that if I go back to 1987, because this is when I started looking at the markets back in 1987, so 30 years ago now. This is the daily chart of the Dow Jones. This is the October the 19th, 1987 crash. So markets going all over the place, but look where the crash stopped, right at our weekly, in other words, higher time frame support. The market made the initial rally up, made the correction down into our Holy Grail TS3 buy setup here before the market started to rally. So back in 1987, there's exactly the same setup as we've just looked at on the 15-minute YM a couple of minutes ago. If you want to go back a little bit further in time, let's go back to 1929. Here's the 1929 high. Here's the initial decline. The initial correction unfolded as an ABC. There was our MTPredictor sell setup as the wave 2. just before the market started to decline for the next 5 years. 3 years. I can't do adding up there, can I? Came into the 1932 low, market then made an initial rally up, did initial correction. You can see there was a TS3 buy setup as well as the market started to rally off the 1932 lows. So I'll just include these just to show you back in 1929 on the famous crash, back in 1987 on the famous crash, exactly these same things kind of setups were unfolding. People say the markets change, but I say they actually stay the same. I think what happens is people say the markets change because we get these random periods. And I think this is what people tend to struggle with. So is this the only time setup we actually look at in MTPredictor? Not just Elliott Wave stuff, we also look at volume-based setups as well. Let's have a look at a chart of the euro. I want to look at this example in webinar. So this isn't the hindsight example. This is one we highlighted at the time. We have a VS label here. What's the VS setup? Well, I'll again put some space on the right-hand side. A VS setup, if I scroll forward, excuse me, a VS setup is where the market goes beyond an important psychological level. In other words, this bar here has made a wide range, big move down below, beyond this prior low. We had a high volume indication on our volume bar here. Ahmed says, does this mean you don't have a losing day in 17 years? Of course you do. Of course you have losses. This is what I'll be talking about when we talk about position sizing in a minute. Losses always happen. This is what we've been saying all the way through the webinar so far, is losses always will do happen. I don't believe in anyone can have a system that actually keeps going for a long time that has a high percentage of winners. I think that's a fool's errand that lots of amateur traders tend to go after, and I'll show you how losses come in a minute. But I just want to talk about this VS setup next before we go and have a look at position sizing. If that's all right, Ahmed. Here, the market here, this is the euro. This is on a 240-minute chart, has made a wide range move beyond an important psychological level. In other words, a low here on high volume. This is by our spike here. Most amateur traders would think this is selling because you get a big move beyond a level on high volume. It seems like selling's coming in. But again, we have our advantage of our DP level. This again is on the chart in advance to give you an idea of where support may come in. If the market then fails to follow through on the next bar, which is here, it means that the volume on the previous bar was not selling, as most amateurs think. It's actually professionals. It's professionals coming in and buying, in other words, selling to the amateurs. Why is this so important? Because what happens after this is the markets tend to make a strong move in the opposite direction. In other words, it's a classic fake out. So how do we actually make use of this at MTPredictor? Well, as always, we like to have the higher time frame chart. In this case, it would be a daily chart. So we'd have had a DP on our chart. That would have been on there literally days before this low came in. Remember, these are on the chart in advance. So as the market then started to drop, in other words, started to drop down into here, this was an area of potential support, then you were thinking, hang on a second, the market is now starting to become clear. If the market reacts at this level, this could be a low, therefore we could have a trade set up about this. So we place the analysis on. Now this is where MTPredictor comes into its own, because rather than just thinking, well, is the market going to make a reversal here and rally, how do you get a trade set up in and around this? Because knowing that the market is going in a direction doesn't allow you to basically control the risk, which is what we'll talk about with our position sizing section. Also does not give you a potential profit target, which then allows you to have a profit not in just dollars but in relation to the initial risk. So this would be our trade setup. If we were wrong, we'd lose this amount. If we were right, we'd potentially move this one. Yes, Tim, this is the euro US dollar, so Forex. Market carried on going up, reached the level there. With MTPredictor, we have a indicator at the bottom here, which is our MTP Trend. It basically gives an idea of the large degree trend. I'm not going to go into detail in this particular webinar on it, but the only thing I want to look at it here is it has two grey bands on it. These are our strength bands. What we use these for is if the market's strong, in other words, has gone beyond, or this indicator has gone beyond the strength band when we reach our first target, which it had one bar previous, which it had here, we then say the market's strong, so we're looking to trail it with our ATR stop, which is our blue, which is our red and blue dots. So in other words, we think the market's going to go beyond its target. If it's weak, i.e. less than this strength band, then we'd look to come out at this target. Again, this is a sort of an adaptive way of trying to decide whether you want to come out at a target or let your profit run. In other words, let the market run. In this case, it carried on going and it's just been stopped out early this morning for about a 6.5 hour profit there. Now, the reason I cite this example now is because we actually looked at this again at the time. This very bar here was when we were doing our training webinar 2 weeks ago. So we do our training webinars on Tuesdays, and we were looking at this at the time. We then reviewed it a week later, which was last Tuesday, when the market was in and around here, and this is the result of it. So I just wanted to show that as an example that was happening at the time. Right, Amit asked a very good question about losing trades. Of course, losses do happen. If I take this off and I go back to the daily chart, one area we also look at for our DP support and resistance is off the last swing off a high or low. So this was the last high, this is the last swing into the high or low, so a DP off this level would be an area of support. Now this area of support would have been on our charts literally for the last couple of months as the market was coming down to this area here. So if I now go back to the 240 chart, you'll see that the market made a nice low here. So just what I've been talking about, this would have looked like a nice picture. The market would have looked like it's making a good support here. The market went up, started to come down. Do you see this little history triangle here? This little history triangle means that at the time, if I right mouse click over that blue buy bar, place the analysis on, at the time there would have been a buy set up there. So it allows you, this history triangle, it allows you to place the analysis on the chart at the time. In other words, there's no point hiding anything because you don't learn anything if you just hide losing setups. So this would have been a setup when the market went through your buy order, came back down, and then went through your stop order, and it would have been a losing trade. So what do we do with losses? In other words, we had a losing trade here, and then we've had a profitable trade here. So most people just put profits and losses in the bank and that's it. But if you use a technique called position sizing, Van Tharp talks a lot about this in a lot of his books. In fact, he's the king of position sizing. What he suggests you do, if I go back and look at our losing trade, what he suggests you do is vary the number of lots, contracts or shares based on a percentage of your portfolio or your account size. In this case, we're looking at a sample $20,000 account, excuse me, and we're looking to risk 2% on that sample $20,000. So in that case, where this entry level was and this stop level was, that would have been going long 14 mini lots. In other words, we vary the number of lots or contracts or shares, depending on what you're trading, to keep your initial risk constant. Why is this important? Well, this losing trade would have only been a 1 risk unit loss. In other words, a 1R loss. Why is that important? Well, if you come down to the next trade, which as we've seen would have been a profitable one, this profit here would have been 6.5 R, or 6.5 times the risk unit, or put the other way, 6.5 times the losing trade beforehand. So I hope you can start to see that suddenly you don't have to have a system that's right 70-80% of the time. In fact, you can only have an approach to the market that's only right 35-40% of the time, and will actually make money because the profits are large and the stops are and the losses are small. In other words, it makes it far easier to basically have an approach where you don't have to be right the whole time. I don't know about you guys, but I think it's extremely hard to have any kind of system that's 70 or 80% right. To do that, because markets go in cycles, you have to take profits so quickly. If you take profits really quickly, you then tend to have the odd big loss that wipes out a lot of your small profits. And that tends to basically make your system go backwards. So this is what position sizing is all about. It's basically keeping your losses small while allowing you to have large profits. And losses will and do unfold. If I go back to our ES example, or our YM example, sorry, the wrong YM chart. Remember I said there was a TS1 buy setup there that I'd come back to? Well, as promised, I'll come back to it. I'll right mouse click over the blue buy bar. This would have taken you into a trade. Market would have gone up, would have come down, and then stopped you out. In other words, this would have been a -1R loss. So no matter how good the trade setups look, you will always have losing trades. But in this case, this loss would have been, again, 1R. Going long 4 contracts, again for a 2% risk. Actually, that's 2.1%. I need to just bring that down again. In fact, I'll show you how to change that. There we go. That's back to 2%. So that would have been a -1R loss. The next trade would have only been going long 2 contracts for, again, the same 2% risk on the same sample $20,000 account. But as we've seen, this time the profit would have been larger at approximately 3R, or if you'd run it with the ATR stop, would have carried on a bit further there. But let's just take it to there. So even if you don't use Elliott Wave, or you don't use any of the MTPredictor trade setups, I do suggest that you look at incorporating position sizing into your strategies, because it does provide a good way of relating your losses to your profits. And can you imagine if you had a system or an approach that on average made a profit 2 or 3 times the losing trades? You don't have to be right all the time. You don't have to be right 60, 70, 80% of the time to make money overall. And this is what Van Tharp teaches in his teachings, as it's a better way to basically approach the markets by using position sizing to keep your losses small and under control. So does what I've talked about so far make sense, in that what I'm looking to do is realize that markets go through random periods when they're basically choppy, they're going sideways, you don't quite know what on earth's going on. We then look to have support or resistance zones on our higher time frame charts, and we're basically waiting till the markets react at those higher time frame support and resistance zones, and that then tells us the market is starting to behave itself. It's like driving in the fog. Suddenly you start to get into a clearer position when the picture becomes clearer. From that, we're then looking to trade setups that are behaving themselves, in other words, having a nice clear picture, reacting off these higher time frame support or resistance zones. Within that, we'll then have losing trades, but the losses are kept small with position sizing, and profitable trades, and hopefully over time the profits will outweigh the losses. Steve K says, can this be automated? Well, that then defeats the whole object of doing things in isolation. This is what I'm trying to say, is that basically over the last 30 years I've seen lots of systems and very few of them stand the test of time. It's because automated systems, although everyone likes them, they think, oh, it's great, I don't want to be a human trader, I want to just have the system carry on and do it. I think, oh, it's great, I don't want to be a human trader, I want to just have the system carry on and do it. Because the markets go in cycles, because it goes through periods when the markets are random, that time you shouldn't be trading. So you can't have an automated system that works 100% of the time if you're only looking to trade when the picture's clear. Does that make sense, Steve K? So that's the whole idea of what we're trying to do here, is we're trying to only trade, or trying to only look for trade setups when the picture becomes clear. And to be perfectly honest, this is the hardest thing to do. And this is the thing that takes the time. And I know a lot of vendors will say how easy trading is and how you can do it within 5 minutes. But over the last 30 years, I've definitely realized that the hardest thing with trading is the psychological part of understanding that markets go in cycles and having the patience and discipline to not trade when the picture is not clear, to wait for the picture to become clear. It is quite hard. Trading is a hard business. It's a lot harder than most people portray. The rewards can be good, but it is definitely hard. Are there any other things we do at MTPredictor? Yes, yes we do. Oops. Let's have a quick look at a daily stock here. One other thing we look at is our Elliott Wave routines. Again, these are done in isolation. If I hover over this bar here and I right mouse click and I do Elliott Wave Intermediate, can you see how this was found as a 5-wave sequence? 1, 2, 3, 4, 5. With the high right at one of our levels where we think that the market is going to make a reversal. Now I think this, excuse me, I've got a bit particularly cough at the moment, but this is one of the things that I think is most Elliott Wave people get wrong. Is trying to pick the end of a 5-wave sequence, trying to pick the end of a trend. So I know on the stock market we've been going up significantly for a long time now, and people are starting to call for the top. Now it's very difficult to call a top. So why do I do an example here where I'm looking to do a lovely example of a 5-wave sequence here that calls that very high? Well, as I said earlier, what we tend to do is like to see how things are working at higher time frame support and resistance. So on a daily chart, if we go out to the weekly chart, here's the last swing pivot high. If I right mouse click on this, I place the weekly decision point on the chart. And when I go back to the daily, can you suddenly see how this 5-wave sequence looks awfully different, in that it's not just a 5-wave sequence ending at a high, it's a 5-wave sequence that's ending at a higher time frame resistance area. So the only time I'd suggest that you try to pick a top or pick a bottom, because that's like standing in front of a freight train most of the time, is when you have other reasons to do it. In other words, in this case, a higher time frame resistance. This was also a VS setup where we had a high volume spike and the market was reversing round that high volume spike. The trade setup would be into that first target. But would you want to just come out of that first target? Well, if we go out to the higher time frame again, you see how I'm working everything off the higher time frames. Where would the next higher time frame support and resistance be? Well, there's our low there. So if we right mouse click, DP, can you see how this gives you an area in advance? I mean, this is the close today, 110.33. It's a long way off this. Is it going to get there? I don't know. all I know is that, scrunch the chart up a bit, is that this is the next area of higher time frame support. Just grab the risk reward now, and if it gets down to this level, suddenly this is a trade of 7.5 times the initial risk. So do you see what I'm doing here is I'm gauging this particular Elliott Wave pattern in relation to the higher time frame support and resistance, getting a trade set up based around a professional movement. In other words, a volume spike. In other words, professionals are looking to move this in the opposite direction. Then using the higher time frame again, support, as a potential longer target to get a higher risk reward. So that's the whole thing we're looking to do, is look to gauge these patterns when the picture becomes clear, but gauge it in relation to higher time frame support and resistance. And all the time, look to use position sizing, in this case risking 0.5% of a $20,000 sample account. That would mean shorting 14 shares. Right. What I want to do now is open it up to questions, because I'm sure there'll be quite a few questions from you guys on what I've been talking about now. And I think the first one's come in from Ahmed, and he says, is there a big difference between the Elliott Wave and Fibonacci concepts? Basically, the levels we have on the chart here are Fibonacci clusters. They're basically clusters of Fibonacci numbers. This is what we have on the charts as our support and resistance levels. So Fibonacci and Elliott Wave are pretty much tied together fairly tightly, because Elliott Wave sequences tend to move in Fibonacci ratios. So this is one thing we've done in the software. We've made it easy to gauge ideas of where markets are going to go to by having the Fibonacci clusters for all the different Elliott Wave patterns, or the major Elliott Wave patterns in there as well. So you can see on this 5-wave sequence, they're just simple areas on the chart. Saves you putting all the ratios on yourself. So that was a good first question. So I'm sure there must be loads of other questions. So do feel free to come in. Alan asked earlier about the time frames charts. I tend to use just time-based charts because I'm quite old-fashioned, and that's what I've been using throughout all my career. But we have lots of customers who use volume-based charts, who use tick charts. Tick charts are particularly good because they iron out the differences when the markets are slightly lower volumes, particularly when we go back and look at the E-minis. You can see here, there's the low volume overnight. Here's the high volume to the day. So tick charts tend to iron that out. What about time frames under 15 minutes? Well, yes, you certainly can. The ones I tend to look at myself is I like to look at the 3-minute charts with the 15-minute for support and resistance. So if I go to the 15-minute chart on the YM, today's been an interesting day where it's been gapping up. But if I go back to yesterday, here's the pivot low before yesterday. And as you can see, yesterday's low came right in at our DP support. If I go back to the previous 15-minute low, that nailed the low on the previous day. And as the market started to rally up here, here was the last pivot high. And that's where the market came up into today and made the high today on the 3-minute chart. So let's go down to the 3-minute chart and see if there are any setups in there. Yes, that would have been one DP sell there. So this would have actually been a losing trade. So remember, it's important to look at losses, and that's one thing I said right at the start. Losing trades can and will, and they do unfold. Again, there's position sizing, keeping the loss under control, but that would have been a losing trade because it came in at 15-minute resistance. So that's a good example there, and thank you for that question. Ahmed says, is there a value in using a price-based chart over a time-based chart? You can use whatever you like, Ahmed. If you prefer to use tick charts or volume charts, that's actually fine. You can do that in NinjaTrader. Like I say, I'm old school. When I first started, I actually plotted all my charts by hand with a graph paper and a pencil. Ezra said, what's the best way to learn Elliott Wave in detail? We've got some stuff on our website that shows the basic Elliott Wave patterns. If you go to mtpredictor.com and then under the resources tab, if I just show that quickly, under the mtpredictor.com, under resources, there's a bit about Elliott Wave theory, Elliott Wave rules, and trading Elliott Wave that I've talked about today, about the isolation approach and the problems faced with Elliott Wave. If you wanted to look at Elliott Wave in more detail, well then you can look at some other books, but basically I developed the isolation approach to Elliott Wave to basically take account of the shortfalls of Elliott Wave as taught traditionally. No, these decision points are drawn automatically. So if I go back to a pivot point here and I right mouse click, I select decision point by the software, it will then place that chart, that level of the chart. And as you can see, you can drag it left and right but not up and down because it's a price level. That's not just a rectangle in NinjaTrader. Those are placed on at certain levels by our software. Ezra, when you say can you decompose waves on the same chart, I'm not quite sure what you mean. Ezra, these are proprietary levels we have in our decision points. So there's some quite complicated maths go on behind these calculations here. While you're looking at that, I'll just bring this up. What I want to also say, as we're getting probably close towards the end now, is what we're offering at the moment is on the run up to Thanksgiving, which is next Thursday, I think, for you guys in the States. What we're offering is a 20% discount off the balance payment for MTPredictor, or the MTPredictor add-ons. We have add-ons for NinjaTrader 7 or NinjaTrader 8 is the platform I've been using here today. The price is $95 to start, and then usually $1,900 after that, but we're giving a 20% discount on all purchases from you guys who came into this webinar till November the 23rd. So you've got a week to have a look at our website, have a look around, ask questions. Please do drop us an email, steve@mtpredictor.com, to ask us any questions you wish. There's no sort of worry about answering questions on that, but there's a 20% discount on the balance payment for any purchases between now and next Thursday. So do feel free to take advantage of that. Again, just make the purchase and we'll take account of that 20% discount on the balance payment for you, so we'll know all the sales that come in. Alan has asked a question, how do you determine when markets are random and should not be trading? Well, we look for when the picture becomes clear. That is the best way to do it, and that becomes experience. It's like in this example here, is that when the market came down into this level, it was reacting off this decision point support level nicely. In other words, at this point, the picture suddenly became clear. As the market started to go back up here, what we could have said is, here, it wasn't quite so clear because it chopped up, chopped through, chopped up, chopped through, chopped back up again, so it wasn't quite clear. If we go back a bit, here's the market chopping sideways. It's not really reacting at any particular level. It's not giving a clear picture. So the best way, I think, is to use experience, and this is what we teach in our training webinars, is when the picture becomes clear and the market is reacting off these levels clearly, the way I describe it is if you can turn to your friend and tell them within 2 seconds or less what the picture of the market is, then it's reacting clearly. Like here, the market's found DP support, initial rally up, ABC correction down, looking for a buy setup. 2 seconds, thank you. Up here, the market's gone through, down, up, through. I don't quite know what's happening, I'm a bit unsure. You're over 2 seconds. It's a market to be avoided at that particular point in time. Or the other way, as I suggested right at the start, is if you actually did want to have a 100% mechanical system, and again I don't suggest that's the best way to do it, is if you follow all your trade setups. Again, you can apply this to your own system, not MTPredictor, but any system you're trading. Have your own setups, follow them 100% of the time, but then plot a 20-period moving average on your own results. And then you'll see that your results will go through cycles. There'll be periods when your system is making money, there'll be periods when your system is not. And then what you can do is then actually trade your system when your own results are above your own 20-period moving average. This is what fund managers tend to do to smooth their systems out. So people have said, well, what happens if you suddenly get into a market where all your setups start failing? Surely you'll lose your shirt. Well, if you're only trading when you're above your own 20-period moving average, you'll have stopped trading and you won't. So, Alan, that's a good way to actually take a professional fund manager's approach. Manager's approach to system trading and just using a 20-period moving average on your own system results. So hopefully that's a good little tip for you. And that will definitely help because that will keep you out of a system that starts to blow up and keeps on losing, but then gets you back into the system as it starts to then make money again. So that's not particularly an MTPredictor approach, but it's a little tip for you based on what fund managers do. Ezra says he's suggesting that a wave 3 should subdivide into 5 waves of lesser degree. Well, it should do, but do we really worry about this? Because here's our setup we're looking at here. As a trader, all we're interested in is the profit and the loss. The profit and the loss. Do we really worry that there's a subdivision in the pattern in the meantime? No, we don't. So this is the whole idea of what is the difference between an Elliott Wave analyst, and I put analyst in inverted commas, where you're trying to analyze the market and then project where it's going to go, compared to a trader where the only thing you're looking to do is control your losses. And remember, losses will and can and do unfold, as we've seen here. But when those losses come through, they're kept small, using position sizing, in this case 1 risk unit. When the profits come through, they're hopefully larger, much larger than the losses, so over time that moves your account up. And that is the difference between a trader and an analyst. So as a trader, you shouldn't really worry about trying to look into markets in too much detail. This is what I've tried to do with Elliott Wave, is try to just take the most simplest parts and use them in isolation, just to uncover tradable setups that have a low risk and a potential high profit. And that is the last part of the webinar, with trying to keep your initial risk under control. Does that make sense to everybody? We're getting some good questions in. So are there any more questions? Because we are approaching just over the 45 minutes now. 50 minutes, in fact. So are there any more questions that you guys would like to ask before we start to wrap the webinar up and bring this webinar to a close? Are there any more questions coming in, or are you all happy? Again, if there are any questions you think about after the webinar, do drop us an email, steve@mtpredictor.com. Peter says, can it be used with Renko charts? Yes, it can. Any standard chart within NinjaTrader, you can place the MTPredictor add-ons onto the chart. Again, just remind you of the 20% discount until next Thursday, which is Thanksgiving, for the purchase of the MTPredictor add-ons. So are there any feedback on what you guys have thought of the webinar today? I'll be interested to hear what you think. If there aren't any more questions coming in, I think people are starting to run out of questions. So Ryan, I think I'm quite happy starting to bring the webinar to a close now, because I think all the questions have dried up. So again, I'd like to say thank you very much to Ryan and thank you very much to NinjaTrader for allowing me to come in and talk about my approach with getting Elliott Wave under control, and hopefully you guys have enjoyed what you've seen, in particular the talk about how markets move in cycles, how we should only look at the markets when the picture's clear, and within that clear picture looking for the higher time frame to then basically do our higher time frame support and resistance levels, then wait till the market's reacting off those. That's when the picture's defined as being clear, and then we look to have trade setups that are in the direction of that clear support and resistance reaction. And within that, keep the losses small and profits large by using position sizing. We've looked at an ABC setup, we looked at an end of wave 5 setup for slightly more experienced users, I'd say, and we've also looked at a VS setup or volume spike. And in fact, actually, that low there, if I right mouse click over that history triangle, was actually a VS setup or a volume spike setup on the YM there as well. John's asked about the training. We have a training webinar every Tuesday. You can sign up for that as well if you wish, even before you become a customer. If you go to our website, it's under the resources tab, and the video on the equity curve is under the resources tab of the MTPredictor website as well. If you can't find it, just drop me an email and I'll be happy to point you in that direction. So again, thank you very much, Ryan. Thank you very much to NinjaTrader.